All right, good morning all and welcome to Genco Shipping Trading's presentation. Thank you for Noble for having us. Starting with the forward-looking slides, statements which you can see on our website as well. Today we have myself, Apostolos Zafolias, Chief Financial Officer presenting, as well as Peter Allen, our SVP of Strategy and Finance. Starting off, to give you an overview of Genco Shipping and Trading, we are the largest U.S.-based dry bulk ship owner, headquartered in New York, with global offices in Singapore and Copenhagen. Our fleet consists of 44 modern, high-quality dry bulk vessels, focused on the global transportation of all commodities, both major bulk and Capesize vessels primarily, as well as minor bulk and Ultramax and Supramax vessels. We get direct exposure to all dry bulk trades transported across worldwide shipping routes, and provide a full-service logistics solution to our customers, with a majority of our business done on a freight per ton basis, meaning that we pick up the cargo and deliver at the required ports. We are listed in the NYSE under symbol GNK, and we're only one of only two U.S. filers providing full transparency and high corporate governance standards. Off the bat, the company's corporate governance standards provide a significant differentiator for us across the shipping space and the listed shipping space, and our number one rating at the Weber report card, which gets published once a year and looks at 50 different companies for a number of ESG factors, provides validation for that. As I mentioned, we have a global footprint with offices in Singapore and Denmark. Those offices provide real-time ability to capture market trends in order to maximize revenue generation, and also provide the ability of our team to be closer to its end customers, both in Europe that are serving the Atlantic, as well as in the Pacific with our office in Singapore. To put things in perspective, the main routes are listed on this next slide, with the biggest routes being iron ore out of Brazil and Australia into China and other Asian destinations. Coal's main routes are historically have been out of Australia, South Africa, and Indonesia into Asia, primarily China and India. And grains historically out of both North and South America, as well as the Black Sea and into Asia and Europe. I do note that currently, given the war in Ukraine, a lot of these, some of these trade routes, specifically those for grain and coal, have shifted around a little bit, and Peter is going to describe that more in the industry section. To put things in further perspective, global trade is 90%. 90% of global trade is seaborne, and dry bulk represents about half of that total. In Genco specifically, we have approximately half of our volumes in 2021 in iron ore, primarily carried in our Capesize vessels, followed by 15% for met and thermal coal. And then our third largest commodity is grains, while cement, fertilizers, and a wide gamut of other minor bulk commodities make up for the balance. We do want to focus a little bit more on grain, as it not only represents a key component of our business, but it is also one of the most essential commodities worldwide and for humanity. 20% of our cargo is loaded. It is made up of corn, wheat, soybeans, and other agricultural commodities, which translate directly into the food that we consume on a daily basis. And it is particularly relevant in the current environment of uncertain crops and shipments due to what's happening in the Black Sea with the Russian war in Ukraine. As such, we do believe that it is particularly worthwhile to watch for developments, both on a human level, but also for our business and a trade level. Our fleet, as I mentioned earlier on, the composition is basically a barbell approach, meaning that we have a balance between the larger vessels, called the Capesize vessels, and the minor bulk vessels, which are represented by both Ultramax and Supramax vessels that carry a wide variety of diverse cargoes. The approach provides upside potential from the Capesize vessels that concentrate on a smaller number of cargoes, commodities rather, and also provides a more stable earnings environment provided by the Ultramax and Supramax vessels serving the minor bulk cargoes. And on the next slide, slide 11, you could see how historically those Capesize vessels have provided that upside. Just as a point of reference, last year in October of 2021, Capesize rates did reach a peak of $80,000, or actually a little bit over $80,000, providing that operating leverage. In addition to that operating leverage provided by just the fundamentals of the Capesize trade, we also have scrubbers installed on those vessels, and those provide additional earnings as they capture the spread between high and low sulfur fuel oil, which has been fairly volatile, but moving up as fuel prices in general and oil prices have increased. When we made the decision to install scrubbers, we concentrated on the Capesize vessels due to the fact that they spend more time at sea. And therefore the investment is paid off quicker. Having said that, having been through, I guess we installed them at the end of 2019, we have now paid off completely the equipment and installation costs. So now anything that we earn because of the existence of those scrubbers is basically the cherry on the top, I guess. On slide 14, we want to talk about our comprehensive value strategy, which is something that we started implementing in April of 2021. And it consists of three key elements: dividends, deleveraging, and growth. In 2021, we concentrated on paying down debt. Having reached our goal to pay down debt to $246 million at the end of the year, representing about 15% net LTV at December 31st. In doing so, we have reduced our break-even levels and set the company up to take advantage of the operating leverage of the fleet in order to pay a strong dividend on a sustainable basis going forward. We believe that the combination of the low financial leverage with a high operating leverage provides an optimal risk-reward model for our shareholders and eventually will lead to a premium valuation, allowing us to use our equity as currency for growth on an accretive basis going forward. I will also mention that during 2021, we completed a refinancing, setting a $450 million facility in place, including a significant revolver of $300 million, which again allows us additional flexibility overall and the ability to grow in the meantime. Looking on slide 15, we just wanted to show you the progression since the beginning of the year. We started off, we finished last year at Q4 2020 at 2 cents per share of a dividend, started the year at 5 cents, and then ramped it up to 15 cents through the 3 quarters, while also paying down a significant amount of debt. The fourth quarter of 2021 was the first quarter that we utilized the new dividend methodology. And based on this new dividend methodology, we paid 67 cents per share, getting us to a 14% annualized yield, even after paying down $59 million of debt during the quarter. To give you a little bit more detail on the formula, this is it on slide 16 here. Straightforward, transparent formula. We try to provide all of the information ahead of time so that analysts and investors can get to the number and have some visibility to the dividend going forward. It's essentially based on cash flow after debt service and dry docking capex, less a reserve, which can be used for growth. It can be used for share purchases. It can be used for smoothing out the dividend if there is a volatile couple of quarters. We will, as I mentioned, continue to provide guidance on that front. Usually by the time that we announce earnings, we have 60 to 70% of our days fixed on a specific time charter equivalent rate, so basically our daily rate that we earn on a per vessel per day basis. So we do provide that, and then we provide a full break-even rate, which gives you everything that you need to know on the expense side. So essentially all that's left to do for the street is to figure out what we're going to earn for the balance of 20 or 30% of the days that are uncovered. I will also note what you see here is the dividend that was paid in Q4 2021. As I mentioned, it was 67 cents after paying down $59 million of debt for the fourth quarter. Now, going forward, we have guided that we're going to be paying down $8.75 million of debt on a quarterly basis, or $35 million on an annualized rate. So if you were to replace that $59 million with a run rate of $8.75 million of debt repayment, that dividend would have been $1.85 per share as opposed to that 67 cents. This is just to say that the operating leverage is evident and the dividend, and it will flow all through down the dividend model as well going forward. Starting from the top side, our revenue is represented by TCE. Our Q4 TCE, Q4 2021 TCE was our highest since 2008 at 24,000. And it showcases the strength of the market during the fourth quarter. Now going into the first quarter has historically been the seasonal low point of the market. We had guided for about 24,000 as well for 87% of the available days when we last announced earnings in February of this year. However, I also need to mention that the spot market today for Supramax vessels is over $20,000 a day, close to $30,000 a day, and while the spot market for the Capesize vessels is around $13,000 per day currently. On slide 18, moving on to the expense side of the equation, we have concentrated and developed this whole dividend model and capital allocation strategy around the expense side. The reason for that is because we wanted to make sure that it is a sustainable dividend formula going forward. That's why we concentrate on paying down debt during 2021 to bring down those break-even levels, and we successfully managed to get our break-even level down to $8,900 for the fourth quarter of 2021 from $12,300 earlier. I will also note that after paying down this debt, we don't have any mandatory debt amortization really through the end of the credit facility maturity, which means that the $8.75 that we're paying going forward is on a voluntary basis. Putting it all together on slide 19, we wanted to provide an illustrative dividend sensitivity slide. As you can see, at $24,000 a day, which is what we achieved in the fourth quarter of 2021, if we were to apply that rate and use our expense estimates for 2022, we would get to a dividend rate of $3.11 per share, approximately 12% yield. And then every $1,000 of increase in TCE is about $16 million of incremental EBITDA for the fleet, which flows straight down to the dividend calculation and represent 37 cents of additional potential dividend per share. With that note, I'm going to pass it over to Peter Allen to go through the market development and the industry side.
Great. Thank you, Apostolos, and good morning, everyone. So I'll start here. This is just a brief historical background on dry bulk supply and demand. Ultimately, it's a very basic and simple supply and demand equation. When we look at dry bulk demand growth over the last 20 years, we've only seen 2 years in which demand growth has actually contracted, and that was the global financial crisis and early on in COVID. So it's really more a supply-side situation. As you can see with the Chinese super cycle in 2003 to 2008, there was a robust period of new building ordering, which ballooned the order book to about 80% of the fleet. So what that did was that led to double-digit net fleet growth from 2009 to 2012, which essentially threw off the whole supply and demand equation, and in turn freight rates declined significantly. So the industry has worked through that supply shock over much of the last decade, and we're in a much more disciplined and a much better supply equation, and the order book now went from 80% of the fleet down to 7%, which is a historical low. And comparatively, we haven't been at a level like this really since 2002, where it was even remotely close to this order book and this supply side situation. So what really happens is when you have an upward surprise on the demand side, like we saw back then, the fleet cannot react quick enough, and it leads to spiking freight rates. So it's essentially, we're in that sort of mode right now where there's just not enough capacity on the water, and it's going to take years if in the worst case scenario, if supply side discipline dissipated, for that supply to come online. So when we look at the current drivers, we've touched on the order book at a historical low as a percentage of the fleet. From a high-level demand side, we're looking at global GDP growth in the 3 to 4% range, driven primarily by China. They have a target of 5.5% GDP growth this year. And the dry bulk shipping market and rates in particular are more correlated with Chinese growth and global growth. Obviously, global growth play a significant factor, but China is the main driver. And when we look at the current factors that are driving freight rates, Q1, as Apostolos mentioned, is a seasonal low for the market. Seaborne supplies tend to increase significantly from the second quarter onwards into the end of the year, and freight rates tend to respond as a result of that. So here's the freight rate development. So Supramax rates are leading the charge right now, close to $30,000 a day. Capesize rates were at 11 yesterday. They increased 20% in one day, so they're about 14,000 now. This compares to our cash flow break even of roughly $9,000. So very healthy levels, even though we were just entering and exiting at a seasonally low point in time. And as you can see on the left side of that graph, there is a steady churn upwards in Q2 to Q4 in terms of freight rates and earnings as well. And that upward movement and then increased cargo volume, particularly from Q2 to Q4, coincides nicely with Chinese policies becoming more accommodative. Right now, obviously there's temporary lockdowns due to COVID in China, but we do see those policies really hitting in the second quarter, towards the end of the second quarter into the second half of the year, which coincides really well with increased cargo volumes, and we think that bodes very well for dry bulk supply and demand overall. Regarding the war in Ukraine right now, as Apostolos mentioned, grain and coal are the two dry bulk trades that are primarily impacted. On the grain side, the Black Sea, typically we see a peak season in the third quarter, and we see a lot of those, there's a lot of uncertainty regarding those exports and if they're going to materialize. But ultimately we see a rerouting of cargo flows. We see the U.S., Brazil, and Argentina exporting a lot more to Europe, as well as Australia to Europe. And the question really remains is, can those volumes that are lost from the Black Sea be made up due to a ton-mile increase? On the coal side, we're seeing more of a rerouting, so Russia exporting more coal to India as well as China, and Europe importing more from the U.S. and Colombia in particular. We also see more coal coming out of Australia to Europe as well. So what this does, we think that overall volumes are going to be similar, maybe slightly down, but the ton-mile impact really is a big driver here, and we actually think it's going to be a net positive for demand growth and trade flows overall. So going back to the order book on the supply side, so we mentioned historical low, about 6.5% of the fleet is on order, 2% left for this year, roughly 3% for next year, and this is on a gross basis. The overall on the water fleet is roughly 7.5% of it is 20 years or older, so there's quite a bit of scrapping potential overall, which is going to offset a lot of the new ships coming on the water. And then when you factor in the fact that we have a low order book and then slower vessel speeds due to high fuel prices and environmental regulations that are coming down the pike, it's a very good and very constructive supply situation overall, which again, when we look at the demand catalysts, it leaves a low threshold for demand growth to have to exceed to tighten fleet-wide utilization and improve freight rates. So overall, and summing this up, for this year and next, we expect demand growth to exceed supply growth, and we're very positive on the overall outlook for the dry bulk market for at least the next 2 years. So with that, I'll turn it back over to Apostolos to finish up.
Thank you, Pete. So just to provide a summary of everything that we talked about today, in terms of leadership, we have an experienced U.S.-based management team and our U.S. filer with a high level of transparency and corporate governance standards. Again, rated #1 in the Weber Research Report, which goes over 50 publicly listed companies. As far as the market goes, demand and supply dynamics remain strong and are forecast to continue to improve during 2022 and 2023. And we believe that we can capture that through our best in-class commercial platform, which provides active management through global commodity exposure and a full-service logistics solution, and a track record of benchmark outperformance over several years. Fleet modernization, we have done quite a bit of it during 2021, selling some of the older, less fuel-efficient vessels, acquiring some newer, more fuel-efficient vessels, and we'll continue to do so opportunistically on a go-forward basis. And we will maintain our barbell approach to fleet composition, meaning that we'll maintain the exposure to the Capesize vessels, which are more dynamic and provide more operating leverage and upside potential during improvement market conditions, as well as the exposure in the minor bulk vessels, which have a more diversified book of cargoes to work with, therefore providing a more stable earnings picture. Lastly, the value strategy, something that we're particularly proud of and we believe differentiates us from the peer group. After paying down quite a bit of debt, we have set up the company with very low leverage, giving the ability to provide meaningful and sustainable dividends to shareholders while maintaining opportunities for growth, being able to use the equity as well as the revolver as currency going forward. And that about does it for us, so if there are any questions, we'd be happy to answer them. All right, thank you very much.